How is everybody doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, we're going to be taking a look at private equity. In particular, where have they been investing their money over the last year in 2024 and so far into 2025? And is that investment really good or bad for small businesses? What are some of the pros and cons there? And what are some of the probably maybe perhaps more extreme situations that we've run into? So we're going to cover three articles today, one from CNBC, one from the Business Journal, and one from S&P Global Market Intelligence. And I think that as we look at all three of these articles, I think people will find some interesting tidbits here, if you will. So let's start out with this. First, we're going to start out covering this article from the Business Journal, which is called "Where Private Equity Firms Invested Billions into Small Businesses in 2024." So this reads, private equity continues to buy up small businesses across the country, pumping billions of dollars into industries ranging from law to energy. In 2024, private equity companies reported $738 billion in deal value across 7,321 separate deals, according to data from PitchBook, broken out in a 2024 American Investment Council report. About 41% of those deals were for under $25 million. While the number of deals is down from the 7,740 recorded the prior year, overall deal value was higher in 2024 than the estimated $729 billion in 2023. However, nearly 50% of the deals in 2023 were for businesses that had under $25 million in deal value, which suggests at least a slight slowdown in small business deals. Overall deal value peaked in 2021 during the height of the COVID-19 pandemic, topping out around $1.2 trillion across nearly 10,000 deals. Private equity remains a vital partner in helping small and mid-sized businesses adapt, scale, and compete on the global stage, said Drew Maloney, president and CEO of the American Investment Council. While an infusion of capital can result in new equipment or geographic expansions for businesses they invest in, that hasn't stopped private equity from coming under increased scrutiny for its small business acquisitions in recent years. Last year, the Federal Trade Commission and Justice Department launched a public inquiry to identify so-called serial acquisitions and roll-ups in which a private equity company has purchased enough businesses in one industry to have an impact on the market. Critics of roll-ups say those deals are small enough to fall below regulatory scrutiny, but end up hurting competition. But for many small business owners looking to sell, private equity companies offer a payday that had previously been missing. That's led many small business owners in industries with skilled trades like heating, ventilation, and air conditioning or plumbing to cash in, especially as owners reach retirement age and as many small business owners feel burnt out. So where is private equity money flowing? So the AIC report broke down where private equity money went to by segment, with commercial services leading the way at 41% of total deal count. That segment encompasses manufacturing, consulting, legal services, and logistics, among others. Consumer services, including household appliances, retail, hotels, and restaurants, came in at 16%. Technology firms also accounted for 16% of deals, followed by healthcare at 13% of total deal count and financial services at 10%. Where deals are happening largely corresponds to the relative population of each state, with California leading in total deal count at 807 and deal value at $99 billion in 2024. Texas ranked number 2 at $73 billion in deal value across 738 deals, followed by Florida, New York, and Illinois. Small business owners looking to cash out with private equity should tackle a number of issues to get top dollar. A study released late last year by business valuation company BizEquity detailed how a company's valuation multiple increases when its cash flow and revenue grow, providing a big incentive for owners to ensure they are keeping costs down and pursuing new opportunities. The report found if earnings double from, say, 250 to 500,000, the value of a company will double or more. Depending on the industry, if that business trades at 3 times valuation, that means it'll go from a value of 750,000 to 1.5 million. That study, published as the BizEquity Business Valuation Almanac, drew from research on hundreds of small businesses. So Despite a chaotic start to 2025 with the Trump administration's seesawing tariffs and an uncertain economic environment, small business owners remain overall optimistic. About 69% of small business owners say they feel positive about their financial outlook for 2025, according to a new study by Goldman Sachs, 10,000 small business voices. About 78% of owners surveyed said they plan to grow this year, and 46% expect to create new jobs in 2025. But those owners did cite several challenges, with 89% saying it's difficult to hire qualified workers, and 62% of those saying it's harder to compete with larger companies on pay and benefits. Meanwhile, about 53% said they can't afford to take out a loan at current interest rates, with most saying lower rates would help their businesses. So this article gives us kind of a good idea as to the deal volume, the amount of deal flow over the last couple of years, and where that money is going. But it also sheds a light on a couple of the practices of what's called serial acquisitions and roll-ups. So now let's take a look at this very interesting article here from CNBC. And this is called How Private Equity Played a Role in Red Lobster and TGI Friday's Bankruptcies. So, private equity has expanded its influence on the bar and restaurant industry, investing $94.5 billion between 2014 and 2024, according to data from PitchBook. But some of these takeovers haven't worked the way the eateries may have hoped. Companies that are owned by private equity firms are significantly more likely to go bankrupt than those that aren't. Wait, what? Say that again. So this was companies that are owned by private equity firms are significantly more likely to go bankrupt than those that aren't. And this was stated by Brendan Ballou, who is the author of Plunder, Private Equity's Plan to Pillage America. There's a lot of incentives for private equity firms to take short-term extractive strategies towards restaurants that oftentimes can lead to their harm or, in extreme cases, to their destruction. In 2024, 21 restaurant and bar chains filed for bankruptcy. 10 of those had been backed by private equity, according to PitchBook. Two of the most notable were casual dining giants Red Lobster and TGI Fridays. Ballou said private equity's transactional tactics like leveraged buyouts and sale leasebacks are often to blame. Leveraged buyouts reference a sale where a firm buys a company using borrowed cash, yet the company has to pay back the debt rather than the firm. Sale leasebacks, if implemented, usually happen in tandem with a leveraged buyout. It's when a company sells its real estate and then has to lease it back. This was key to Red Lobster's failure, said NBC senior financial investigative reporter Gretchen Morgensen. Not only did it have debt that it had to repay, it now had rents that it had to pay that it had not had to pay before. And to add insult to injury, the new owner of the properties increased the rents to above market rates. At the same time, private equity can also infuse investments and much needed cash into a restaurant concept, which can prolong the company's lifespan. The goal of private equity is to be able to own the business, improve the business, and exit the business, said Donna Hersherich, Columbia Business School senior lecturer and co-director of the private equity program. It's impossible to know what an outcome without private equity's involvement would have looked like. We don't say, okay, here's a restaurant, it's owned by private equity, how does it do? Here's the same restaurant, and it'll be our control group, said Hitcherich, if I'm saying her name right. Certainly, as in any business, there are some operators that are more successful and some operators that are less successful. Yeah, I think that's a kind of a load of crap. So, but again, this article gives a great example of basically, again, some of the tactics that are used by private equity when they get a hold of your company. Some of them, the sale leaseback strategy, that's basically a real estate play. That's the private equity looks at your balance sheet, they look at your company and they say, holy cow, there is a lot of equity currently available in this real estate. And so the first thing we're going to do is we're going to get control of that company and we're going to sell off all the real estate and pay ourselves back immediately with a tidy profit. And we're going to, instead of, and yes, they will take some of that cash and put it into the company, but they're also taking a lot of that cash and putting it into their pocket. And now they're saddling the company with huge leases that they didn't have before. Again, really taking away from the free cash flow of the enterprise, putting them in a bad bind. And then, once, and again, part of the problem with some of these strategies is once these companies have been pilfered, so to speak, private equity in a certain regard, like they don't care if the company makes it or not because they got their money out of the transaction already. So now it's like if the company makes it, that's great. We'll make even more money as we grow it a little bit, and then we'll sell it again down the road and make even more money. But if it fails, okay, whatever. We basically got our money out of it on the real estate play. So that, and again, I'm just using this as an example of kind of what happens. So, and okay, so let's take a look at this final article right here. And this is basically just says private equity deals in asset management sector hit 3-year high. So private equity investment in asset management soared to a 3-year high in 2024 as deals targeting wealth managers combined with strategic acquisitions to drive transaction activity. Again, another example of how private equity is investing their money. So private equity and venture capital firms invested $20 billion in asset management deals globally in 2024, an 89% increase over the prior year total of $10.78 billion, according to S&P Global. It was the highest annual total recorded since private equity firms invested $22 billion in asset management deals in 2021. And then we get a nice chart here, basically just saying the aggregate transaction value and the number of deals. And you can see there, basically 21 and 22 were big years. 23 a little bit down, but then in 2024 they came out, really strong here in this particular area. So the uptick was driven in part by private equity's ongoing consolidation of the fragmented wealth management industry. However, not all deals fit into private equity's game plan of buy, build, and sell. Strategic acquisitions of asset managers by private equity firms seeking to expand their slate of investment strategies and quickly grow their roster of investors also play a role, according to Kelly Bobo, partner in the investment management and M&A practice groups of law firm Haynes Boone. If their goal is to grow, there's only so much internal growth that you can continue to do. It's an easy way, just like with any other sort of strategic M&A, to grow through acquisition. And then it kind of gets into expanding their reach and then targeting wealth managers and then the largest deals. And then it talks a little bit about Europe here. And then outlook. So private equity investments in asset management are expected to further increase in 2025, driven by the aim of democratizing access to private markets. You got to love that. Global wealth held by individuals who qualify to invest in alternative assets has been estimated at, I don't know. Doesn't say. Additionally, given the amount of dry powder, limited partners want to see their capital put to use. Dry powder totaled $2.49 trillion as of February, down slightly from $2.55 trillion in December of 2024. But that is a lot of what they call dry powder in the private equity arena. So really interesting here, kind of giving you a glimpse of an example of what's going on here in the private equity world. So what do we take away from this? Private equity has a ton of money right now, a ton of dry powder that they want to and need to invest in businesses. We've looked at a couple of the different strategies as far as like roll-ups. We've also looked at sale leasebacks, some of the different things there. We've looked at some of the different industries that the private equity likes, restaurant, hospitality, private equity, or not private equity, wealth management. So, and hopefully this just gives people a flavor or an understanding. So I think that private equity absolutely has its place. There are some good things about it. I mean, again, if you're like, let's say a quick example, like let's say you're 60 years old and you really want, you're sitting there and you're going, okay, I want to retire in 5 years and I've built a great company over the last 25, 30 years. And I need an exit strategy at this point. Well, maybe you call up the private equity guys and you say, hey guys, listen, my business, I run a $10 million a year business, but if you guys will invest some money in me, I can blow this up to a $30 or $40 million a year business in the next 5 years. And then I can really cash out at that point, and basically a 5 to 7 year time horizon is usually what private equity looks for. So that could be a win-win for everybody. They say, oh, hey, this guy's great management. We'll give him the money. He could blow the company up. And then in 5 years, we could sell this thing. Everybody gets a big chunk of cash at the end of the day and goes home. Good thing. But then there also is a bad side to this, was what we saw with like the Red Lobster and the TGI Fridays. I would also go back to an example of Toys R Us. Toys R Us was also a victim to one of these strategies. So there's always good and bad and pros and cons. But I think it's just important to know options that are out there. It's important to know pros and cons. It's important to know kind of what's going on in that private equity space. So we'll continue to keep tabs on this, and I'll continue to bring people updated information as we have it as the year goes on. So, but I will wrap up with this today. If you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, please check out some of the other content on the channel. Have a great day, and I will see everybody again real soon. Thanks a lot.